There is another means of transferring the ownership, and those are through buy-sell agreements or redemption agreements. Again, those are agreements that oftentimes, again, uses insurance to help fund the bottom line. But a buy-sell agreement or a redemption agreement is literally an agreement amongst the shareholders of the company that if a certain event happens, death, disability, retirement, the remaining shareholders are then to buy out the leaving shareholder. And that may be over time. In other words, payments can be over a 3-year, 4-year, 10-year period, or it can be done with a lump sum depending on whether the value of the business is within reach and whether you've got products such as life insurance in order to fund it. There has been a vehicle that has been used by estate planners for the last decade, which is to, in order to pass that asset on to those you wish to have receive it, some companies are using these redemption agreements or buy-sell agreements and applying a discount factor to them, because if the successor shareholders own less than a majority, or the selling shareholder owns less than a majority, the current practice is to use discount factors for lack of marketability and lack of control, and thereby discount the value of the asset in order to pass that asset on to those you want it to go to. The reason those discounts are important is because right now the federal estate tax law provides that the first $5.45 million is estate tax free, but after that there's a substantial tax. As a result of that, if you have a successful business that is worth more than the $5.45 million, you run into the estate tax issue. And obviously reducing the estate tax, which starts at over 40%, is a major estate planning goal, and again is involved with the succession planning, because if you're going to have to pay those estate taxes, that's less money available for your loved ones, and likewise less money available for the business, which obviously needs its own working capital. So the use of these discounts for marketability and lack of control have been standard business planning for many years, and just this past month the IRS has announced a new regulation that very well may end the use of these discount factors. So as a business planner, it's back to the drawing board if that event hasn't happened and part of your plan was to use the discounts. You're going to have to revise or reanalyze those factors and look to some other means in order to try to get the asset to those you want it to go to with the least amount of federal estate tax payable.